The Federal Reserve is expected to cut rates for the first time since 2008, with stocks being cautious ahead of the Fed meeting later this week. Joining me to talk about this today is Peter Boockvar. He's the Chief Investment Officer over at Bleakley Advisory Group. Peter, good to see you. It's been too long.
Yes, great. Thanks for having me.
Well, thank you for joining us, Peter. Look, it's largely priced in that a rate cut will take place at this week's Fed meeting. But what can we expect from monetary policy guidance beyond that?
Well, that's the big question, because that's where the discussion shifts, because this is a very well telegraphed rate cut. And what does the Fed do next? The bond market's now pricing in a 60% chance of another cut in September. But I think there's pressure on the Fed, not necessarily to commit to that at Wednesday's statement and in the Jay Powell press conference, because we know the data can go either way. Now, they're responding to the weakness in trade, the weakness in manufacturing, with a lot of that having to do with the slowdown in China and also worries about tariffs. But I think they need to see whether this further spills over into services. So they'll give us the cut, and I think they'll take a more play-it-by-ear type mentality through August until they see more information ahead of that September meeting. While the bond market is saying, and the stock market certainly is, well, it's usually not just one cut. Usually it's the beginning of a rate cutting cycle, and they're hoping for more. But I don't think the Fed's initially going to give the market any tilt in that direction just yet. But
Peter, in your opinion, is this the right time to be loosening monetary policy? Quarter two earnings have come in strong so far, with more than 77% of S&P 500 companies reporting earnings above estimates. So is it the time now?
Well, I'm very sympathetic to the argument for a cut, because in my opinion, the manufacturing/trade side of the U.S. economy is in a recession, and you can argue it's a global recession in those two areas. So it's really just the consumer that's keeping us afloat here, as we saw in last week's second quarter GDP number. On the other hand, I'm of the opinion that a rate cut's not going to help. And the bond market, at least for the housing sector, has already cut 75 basis points year over year if you look at the average 30-year mortgage rate. And I'm afraid that the Fed is going to be sucked in to not just one cut, but many, and they're going to repeat the mistakes of the Bank of Japan and the European Central Bank. So if I was the head of the Fed, maybe I'd give the market their 25 basis point rate cut, but I'd be the first to say that we're only going to cut modestly, if at all, going forward, again, because rate cuts aren't going to help. They're not going to instigate behavior that is not happening already, because the cost of capital is already so low.
Right.
So credit is certainly not an inhibiting factor on anything. And I'm just afraid that they get sucked into the mistakes of the ECB and the BOJ of just continuously cutting rates, deadening the yield curve, damaging bank profitability, and only generating higher bubblicious type asset prices that eventually ends badly.
Finally, Peter, what sectors are you liking right now? I know you've talked about agricultural products maybe headed for higher prices next year. What are you liking right now?
So as you mentioned, I like that space. I think the spring planting season was a disaster, with a lot of that having to do with weather. The farmer has been in a 7-year bear market with falling crop prices, and we're now finally seeing higher prices. So while this planting season will be poor, I think we're setting ourselves up for a pretty robust planting season in the spring and much higher prices next year. So I particularly like the fertilizer stocks. I am a bull and remain so on gold and silver, and have been a painful bull over the last many years, since the peak in 2011. But I think that this move higher over the past month is for real and not just another fake out. It's for real because the Fed obviously is embarking on what will likely be a rate cutting cycle, even though, again, on Wednesday they'll hint that it's possibly one and a pause for now. But you have rising debts and deficits. For all the talk about a strong dollar, it's really no higher than it was in 2015. And I think that people are really getting around to the idea that central banks are going to keep pushing and pushing and pushing, but to really no result. And with $13 trillion of negative yielding securities, you can overlay that chart with the price of gold. And silver has lagged gold.
Right.
Silver will catch up to gold. So I'm expecting, higher prices there. And the last asset class that I'll mention, sorry to interrupt, I like emerging market local currency debt because I do expect the dollar to roll over once the Fed begins this rate cutting cycle. And I think emerging market bonds are an area to get yield, and you can get a local currency kicker if I'm right on the dollar.
Yeah, just a point on your silver price. That's a lot of catching up to do. If silver were to, this gold silver ratio at levels we haven't seen in decades here, Peter. So make the case for silver.
So there's no question that it's getting grouped into the industrial side of base metals. And that is obviously because of the slowdown in global growth. But I think that the recent move higher in silver has sort of shifted that mentality and it's precious metal first and foremost, and that with this move higher in gold, silver should follow. So there will be a tug of war, and I think we'll have some back and forth. But I think at some point it's going to shift and be viewed more as a precious metal and less as an industrial metal. And that's what will lead it higher relative to the price of gold. And that ratio that you mentioned will compress further from here.
All right, Peter Boockvar, thank you so much for joining us.
Great. Thanks for having me.
Catch up with you soon. And thank you for watching. We'll be back tomorrow.